In March 2020, the S&P 500 dropped in value by over 30%. If you had invested $10,000 at that time and bought the dip, you'd have nearly $20,000 today. In fact, buying nearly any stock during the March 2020 dip would likely have resulted in positive investment returns. But of course, hindsight is 2020, and it's very easy to point out what we should have done in the past. But this raises a very interesting question. Does buying the dip actually work? The concept is fairly simple. Wait until the price of a stock or crypto falls by a certain percentage and then buy it to take advantage of the lower prices. Of course, you're doing this with the expectation that the investment will subsequently increase in value. But that's really all there is to it. Buy low, sell high. Buying the dip became somewhat of an internet meme sensation during 2020 and 2021, as more and more people started to adopt the simple but surely bulletproof philosophy. In fact, Google searches for the term buy the dip increased by 1,500% in March 2020 alone. Still though, is there actually any merit to buying the dip? I would say yes, but only if it's used correctly as part of a wider dollar cost averaging investment strategy into an investment which makes sense in the first place. Dollar cost averaging is an investment strategy which involves periodically making small investments into the market as opposed to investing a big lump sum at one single point in time. By doing so, you're reducing the risk of investing all your money at the peak of the market. Instead, you're investing small sums of money consistently, irrespective as to what the market is doing, thereby averaging out your returns over time. Dollar cost averaging is most important when someone first starts their investing journey. In my last video, 4 places your paycheck needs to go in order, we talked about how after you figured out what the minimum amount of cash is that you need to have in the bank account in order to feel comfortable, that you then need to start investing any excess cash over that amount. So if you consider someone at the beginning of their journey and they're just about to invest for the first time, it's very likely that they have lots of excess cash in their bank. So the question becomes, do they invest all that cash at once, or do they drip feed the money over time? For most people, drip feeding or dollar cost averaging their money into the market is going to be the best play initially. Not because it will guarantee the best results, but simply because it takes time to get used to your money fluctuating in value. And if you invest a sizable amount of money right away, those fluctuations can be quite scary. In fact, dollar cost averaging was found to slightly underperform investing via lump sums by Charles Schwab in the investment period between 2001 and 2020. However, once the initial investment has been allocated to the market, it then becomes a question of how you'll invest future money, which becomes available to you via your salary or otherwise. This is where buying the dip might come into play. Imagine a scenario where you're consistently investing a fixed amount of money into the S&P 500 each month. You're fully committed to long-term investing and have no plans to sell your investments anytime soon. All of a sudden, the market drops by 20%. This presents a great opportunity to invest at a discounted price. So instead of investing your regular monthly amount, you might increase the investment to take advantage of the dip. This, in my opinion, is a sensible way to buy the dip. Now, obviously, we have to consider the reasons why the market dropped by 20% in the first place. But really, if you're investing in stock market index funds and plan to do so for decades, there aren't many circumstances which would justify not taking advantage of the dip. But the same isn't always true for investments like company stocks and cryptocurrencies. At the beginning of the video, I mentioned that buying the dip makes sense provided the investment decision itself makes sense. An asset falling in value by a significant percentage is not justification itself for investing in that asset. If there's one thing you take away from this video, let it be that. Any investment decision must be underpinned by solid investment rationale. For example, if you wanted to invest in a company stock, you'd need to do the necessary research, which would involve understanding the business model of the company and analyzing its financial statements. Only then can you understand the relationship between the company and the share price of the company. Without that research, what you're really doing is gambling, not investing. This applies no matter how far the share price falls. In the words of Warren Buffett, price is what you pay, value is what you get. And you can only understand the value of your investment by doing the research. Many newcomer investors are hesitant to invest in the market when it's at all-time highs and prefer to wait until there's a dip before starting or continuing their investments. This is a form of buying the dip. But is it really a smart move? Research from JP Morgan tells us that if you were to miss the best 10 days of the stock market over the last 20 years, your return on investment over that time period will be cut in half. In other words, the most important factor is participating in the market consistently over time. Sitting on the sidelines and waiting to invest at the perfect time is not only impossible, but it also costs you a lot of money. In fact, research carried out by Thomas Shofai and Majid Simon in the paper Buy the Dip came to the same conclusion. Quote, our paper stresses the importance of continuous allocation to an investment account with or without the dip. If we consider the effects of inflation on the purchasing power of our cash, as well as the opportunity cost of holding excess cash in the bank, this makes total sense. The other factor you have to consider is the effort of keeping tabs on the market day in and day out, waiting for the opportune moment to invest. I'd much rather commit to investing a fixed amount each month and really only pay attention if there's a major move in the market. Now, for those of you wondering whether Buy the Dip can be turned into a legitimate investment strategy, the answer is yes. In order for this to be possible, we have to define what constitutes a dip. Is it a 1% fall in the price of an asset? 5%? 10%? 20%? 50%? How can we buy the dip if we don't know what dips to buy? Defining how much of a dip is required before we invest is known as the drawdown threshold. Typically, we'll pick an investable asset like an S&P 500 ETF, and we'll say to ourselves that we're only going to invest once the S&P 500 falls 10% below an all-time high. If the S&P 500 falls by more than 10%, we'll either lump sum or dollar cost average our money into the market until the S&P 500 hits a new all-time high. Once that happens, we'll stop investing and we'll start to stockpile our cash again while we wait for another dip of 10%. Nick McGooley wrote an interesting article for MarketWatch on this topic, and he used some charts which explain the strategy quite well. This first chart shows how a buy the dip strategy works. You're only investing when the required dip has been met, and that investing continues until a new all-time high is reached. At that point, our purchases stop completely as the market continues upwards. So the opportunity cost here is having excess idle cash in the bank while the market continues to provide returns to investors. And the higher we set our required dip, the more likely it is that we'll be sitting on the sidelines for an extended period of time. This is the main problem with buying the dip. Nobody knows where the stock market is going to go today, tomorrow, next month, or next year, meaning you could be sitting on cash for decades waiting on a dip that never comes. Meanwhile, you've missed out on tons of capital appreciation. Nick also did research on how dip size impacts performance. As you can see, having a dip requirement of between 10 to 30% gives you about a 1 in 4 chance of beating out a dollar cost averaging strategy over a random 20-year period between 1920 and 2020. If we increase the dip requirement to 50%, your odds become about 1 in 2.5. Irrespective of the dip size, you're unlikely to beat out a dollar cost averaging strategy. This second table tells us that the higher you set your dip threshold, the larger your potential underperformance becomes. What this means is that smaller dip thresholds are less likely to outperform a dollar cost averaging strategy, but they'll also likely lead to smaller underperformances, whereas larger dip thresholds are more likely to outperform a dollar cost averaging strategy, but they'll likely lead to larger underperformances on average. The conclusion here is that becoming hyper-focused on buying the dip is simply not worth your time. Not only does the data not support the strategy, but it's also extremely inefficient in terms of the time investment required. In my opinion, the best investing strategies are the ones which you can automate, so that you never have to think twice about your monthly investments. As a long-term investor, I don't care about what happens in the short term. I'd much rather stick to a defined dollar cost averaging strategy, and if there happens to be significant dips along the way, I'll allocate some more money to the market to take advantage of them. But I'm in no way stockpiling cash in my bank account in anticipation of that happening. Remember, there's no guarantee that a significant dip will happen anytime soon, no matter what any analysts, commentators, or investing professionals say. The value of cash in the bank is being eroded by inflation at rates not seen for decades. And I don't know about you, but I'd much rather have that money working for me in the market. It's cliche to say, but time in the market really does beat timing the market. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.